Welcome to Fin Concepts Made Easy, simplifying concepts one topic at a time. In our previous video, we understood the concept of sustainable growth rate, or SGR, the maximum rate at which a company can grow without needing any outside funding. But what if a company wants to grow even faster? That brings us to today's concept, external financing required, or EFR. Think of EFR as the next logical step after SGR, because once growth exceeds what the business can internally sustain, one big question arises: how much extra money will the company need from outside? That's exactly what EFR helps us answer. Let's understand. What is external financing required? External financing required refers to the additional funds a company must raise from outside sources, such as bank loans, debentures, or issuing shares, to support its planned growth. In simple words, if SGR tells you how fast you can grow without external money, EFR tells you, if you want to grow at a certain rate, how much external money will you need? That makes both concepts deeply connected. Why does a company need EFR? Whenever sales grow, the company usually needs more inventory, more machinery, more receivables, and more working capital. All of this requires funds. Some of these funds come internally through profits. Some come automatically through suppliers giving credit, but if those are not enough, the gap must be filled externally. That gap is EFR. The formula for external financing required is EFR is equal to asset by sales into change in sales minus liability by sales into change in sales minus projected sales into profit margin into retention ratio. At first glance, this looks complicated, so let's break it into simple parts. It can be simplified as EFR is equal to asset needs minus spontaneous liabilities minus retained earnings. Or even simpler, funds needed minus funds available. That's all. Now let's understand each part. Part 1, asset needs. This is represented by asset by sales into change in sales. This tells us, if sales increase, how many additional assets are needed to support that growth. Where asset by sales means asset to sales ratio. This shows how asset intensive the business is. And change in sales is target sales minus current sales. In simple terms, it means for the current level of sales, how many assets are there, and how much those asset requirements will increase as sales grow. Example, if every rupee 1 of sales needs rupee 0.60 of assets and sales increase by 20 crore, then extra asset requirement will be 0.60 into 20 equal to 12 crore. This is the funding requirement. Part 2, spontaneous liabilities. This is represented by liability by sales into change in sales. These are liabilities that naturally increase with sales. For example, trade creditors, outstanding expenses, accruals, these act like free financing. If sales grow, these liabilities also grow automatically. Suppose spontaneous liabilities are 15% of sales, and sales increase by 20 crore, then 0.15 into 20 equal to 3 crore. This means 3 crore of funding is automatically available, so this reduces the need for external financing. Part 3. Retained earnings. This is represented by projected sales into profit margin into retention ratio. This shows internal funds generated from profits, meaning how much profit is retained inside the business. Suppose profit margin is 10%, new sales are 120 crore, and retention ratio is 70%. Then profit would be 120 crore into 10% equal 12 crore, out of which 20% is retained, which equals 8.4 crore. This is internal funding. Again, this reduces external requirement. Numerical example. Let's take an example. Suppose ABC company has the following. Current sales 100 crore, total assets equals 60 crore, spontaneous liabilities equals 15 crore, net profit equals 10 crore, dividend paid 3 crore, target growth rate 20%. Let's calculate step by step. First, asset by sales will be 60 divided by 100 equals 2.60. Liability by sales will be 15 divided by 100 equals 2.15. Change in sales, 100 crore into 20% equals 20 crore projected sales. 100 crore plus 20 crore equals 120 crore. Profit margin, 10 crore profit divided by 100 crore sales equals 10% dividend paid is 3 crore, which makes dividend payout 30%. Then retention ratio would be 70%, being 1 minus dividend payout ratio. Now apply the formula. EFR equals 0.60 into 20 minus 0.15 into 20 minus 120 into 10% into 70%, which becomes EFR equals 12 minus 3 minus 8.4, EFR equals 0.6 crore. This means ABC company must raise 0.6 crore externally to achieve its 20% growth target. How to interpret EFR? The result can mean three things. If EFR is greater than 0, the company needs external funding. If EFR equals 0, growth is fully self-funded. This is the break-even point. That's where growth equals sustainable growth rate. If EFR is less than 0, the company generates excess funds. It can use that surplus to repay debt, invest more, or pay extra dividends. EFR and SGR, the connection. This is important. SGR and EFR are two sides of the same coin. SGR asks, what growth rate needs 0 external funding? EFR asks, for a target growth rate, how much funding is needed? At SGR, EFR becomes 0. That's the connection. So if target growth exceeds SGR, EFR will be positive. Now let's see how businesses actually use this. 1. Capital raising decisions. Investment bankers use EFR models when advising companies on IPOs, rights issues, private placements, or bond issuances. They estimate future funding gaps. 2. Bank loan analysis. Banks use EFR while giving loans. They check, can internal profits support growth, or will the company need extra debt? This forms part of working capital assessment. 3. Private equity and venture capital, PE and VC investors use EFR to estimate how much capital the company may need over the next 3 to 5 years. This helps them plan funding rounds. Conclusion. So to summarize, EFR tells us the amount of outside financing needed to support growth. It helps companies plan their funding needs in advance, and together with SGR, it gives a complete picture of growth sustainability. Thank you for watching. Keep learning, keep growing, with Fin Concepts Made Easy. If this video helped you, do like, share, and subscribe. See you in the next concept.